Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Wednesday, November 13th, 2019. We do have some potentially significant technical developments to cover today. So for the first time in a while, there's something worth pointing out, and well, every day it's worth monitoring the charts. But again, we haven't had any really thing close to a significant technical event till today, and today it's just we'll see. There's still work to be done. So let me just back up real quick. We'll go through the charts, and I want to show you some levels to watch, what happened today, and then I want to roll into something I like to speak to from time to time again, and that is asset allocation and diversification, the benefits of trading there. But we'll start out with the charts here, and to do that, let's start out with this morning, the chart I posted before the market opened, QQQ and NQ support levels. So what had happened is last night in the after hours trading session, we had NQ breakdown. If you recall, we have these levels here. We have this trend line. I'm going to get to it in a second. We broke down, made a little back test from below, and as I said there, NQ crossed below the trend line there, the 60-minute uptrend line, and back tested from below. Although the breakdown was not impulsive. That's very important to me. You want to see a breakout of a stock or breakdown. Ideally you want to see with impulsive buying or selling. In this case, a bearish chart pattern. It's a bearish rising wedge. You want to see impulsive selling. We saw a little bit of a blip there, a little bit of an impulsive reversal, but not much. And I said, and more importantly, NQ, the NASDAQ 100 futures, still need to take out the 8,200 level right here. This 8,200 support I've been harping on for a while to open the door for a move down to my near-term targets, as you can see. So here's the scenario. And again, that was from this morning. And I mentioned there it is, NQ or QQQ starting to break the trend line on the 60-minute chart. But I said we need to break 199.80. That's about comparable to that level. I think if you can get NQ or QQQ, I'm sorry for you ETF traders, QQQ, get it, solid breakdown below 199.80. I believe that should open the door for that pullback there to this target zone here. Okay, so now this is the updated chart. I'm going to zoom in here so you can see it a little better on the YouTube channel. And I have indicators, everything on the chart. So we're zooming in, and here's what happened today. First of all, I've had this level up here. You can see it in that chart this morning, 82.7850 on this particular charting platform. It doesn't snap to the nearest quarter point increments. NQ trades in quarter point increments, so there is no print at 82.7850. So let's just round that off. And again, these are, on an 8,000 point index, you can go up a couple points, down a couple points. But what I'm noticing here, and that's why the line is there, is this has been a level to watch. We popped above it briefly, but couldn't hold it there. After we failed to hold that level, those previous reaction highs, we moved back down with an impulsive red candle, hit the trend line, and today, again, we'll zoom in even a little bit tighter, you can see that so far, and this is just kind of micro analysis, if you will, nothing big right now today, but it's a start. It's just showing that this is where NQ, all the sellers stepped in. The buyers could not take it above that 82.78. We'll call it 82.80, rounded up. So you have a couple things. There was a breakdown last night. We had a breakdown, a perfect backtest. I've not modified this trend line, kissed it perfectly, followed by an impulsive rejection. So that's number one. Came back up today. This is today's trading. That's last night, earlier today. And then we had an impulsive drop here. Now, so this is all to be continued. This is a live chart. This is where we're at right now after the close today. NQ still trades, and then it shuts down for a little, and then it'll reopen tonight. So those are the levels to watch. Really, today's highs, you call it, rounded up a little, call it 82.80 or so, and then you do have a previous reaction high. But what we need to see to get any type of sell signal, as I said, this market's in an uptrend. I've made that very clear. No sell signals, nothing remotely close until at least today. This is an early sell signal, but as I said, and I've been saying, when you're in a trend like this, you're in low volatility, a slow grind higher, with virtually every little dip, no matter how small it is, being bought up. That's it's not a voracious trend. Some people, I've seen comments, and you would think this market's shot up and going to the moon. I'm going to get to that in a second, but so it's far from being an explosive rally, but it is a persistent rally, and as such, you don't want to short, jump in head first short with everything you have on the first, breakdown. You want to see a little bit of evidence. Now, I did post and I'll show you that in the trading room today, for the first time in a while, relatively speaking. I'm usually in and out of NQ 3-4 times a day. When the VIX is high and volatility is high, I'm posting day trading opportunities and active swing trading ops in the trading room all the time. But I did post the first short entry in a while right here on NQ today on this back test, and that was right before we had a big spike down here. So this kind of segues into my next discussion, but before I leave the charts, remember that's a start, but we'll need to see a break of 8,200. I think there's a pretty good, well-defined support right here, and then that again should open the door for a move down to those minimum, what I call preferred swing targets right here, about 80.40 to 80.50 or so, and then about quite likely down here to about 79.78. We'll see. And on that too, before I move away from the charts, the whole we'll see thing is it'll kind of give you an idea of what's in this market. We know it's on running on fumes as far as volume goes. Very, very low volume lately, and price comes first. Price is first, volume is a distant second in my book. You'll hear people say, oh, volume needs to confirm. No, price comes first, so you can't take anything away from the breakout. But I like to watch the price action. So let's say we do get that sell signal. We break 8,200 and come here, maybe hiccup or not off the 81.22-ish level, and we come down here. Or let's just let me play this out another way. Let's say we break 8,200, but we come down to that first support I have, where I'd expect at least a minor reaction around 81.22, and then the market does this, just explodes. The buyers step in, and the market makes a new high, and never looks back, at least not for a while. Very bullish. Shows me a tremendous, the supply-demand dynamics are still clearly bullish. The buyer stepped in on a very shallow dip earlier than I would have expected. I expect a reaction there, but I think it'll be fleeting and then come back down here. And so if that happens, then how do they act here at 80.40, 80.50? If I thought this market had another 10-15% or more upside without the risk of a decent correction before then, I can tell you this is where I would be buying here a little bit. I'd be buying a lot more here, and I'd be, if I had, let's just pick a number, whatever your number is, 50,000 I want to allocate in addition to my, long positions. I'd scale in, take a little. By this point, I'd be all in. That's where I'd be, have deployed my last dry powder for the next leg up. So I watch that. And so what happens, or what could happen, if that happens, then hey, maybe the market's got quite a bit more to go, at least in the near term. But if the buyers fail to step in and any reactions are very muted or none at all, and you break on through those levels, then that starts to give you a tell really on what's going on. And again, at that point we might turn our focus more back to the daily charts and maybe even weekly charts. But again, first things first, please don't get ahead of yourselves, or we don't even have that break of 8,200 yet. We do have what is somewhat encouraging, because this is the best trend line I could draw now for a long time. It goes back quite a ways, and it has cracked. And also on QQQ, I showed you to watch it there. We cracked, but there were two things, as I said before. Number one, although that red candle through there is impulsive, but no follow-up selling, we cracked down. We hit my first support, which I've had here before it was even hit today, at 263 cents on QQQ. Look at that, all day long, boom, boom, boom. A little bit above there. I might have it set a hair too low, but so we bounced, and this is a very small range here. We're talking a range of 0.5%. There are days when volatility expands. QQQ has daily swings of 5% more. This is 0.5%. So again, you can't get excited, nor, and again, the other takeaway is, yes, a breakdown of a trend line that I was looking for as a potential sell signal, and you got that, but you didn't have impulsive selling following it. You had a back test, and you failed every attempt, but you didn't go very far. So let's, like I said, to be continued. Let's not read too much more into it. If they just power on through here, or just be another whipsaw in a long line of whipsaws lately. But if they break 263 cents, how does it look? Would it come down here? Do we smash right on through there? We keep going? Like I said, I think if we take out 199.80 as well as 8,200 on NQ, I believe that will open up the door to the move down to this target zone. Okay, now I want to pass along, talk just real quickly about two things. Asset allocation, something that if you follow my YouTube channel and you're not a subscriber to the site, and I've seen I don't regularly have time to read or even respond to the comments. I do appreciate feedback on the site, on the YouTube channel. I do really very much appreciate the thumbs up. But every now and then I'll read, someone that's, oh, you're getting killed in the market, and you have to understand. I'm going to go through this in a second. 90 plus, easily, if not 95%, counting out my day trades and active trades, 90+% of the trading ideas I do, swing trades, investments, are not the stock market. They are not QQQ. They are not NQ or SPY or the S&P 500. They are individual stocks. They are sectors via sector ETFs. They are commodities, precious metals, gold, silver, currencies, cryptocurrency, marijuana stocks, you name it. In fact, I don't follow any other services, but I would be hard pressed. I can't imagine, if you've subscribed to the site for a while, you probably know what I'm saying. I doubt there's many other services out there that trade so frequently such diverse instruments. One day, I'm talking about Bitcoin, for example. We just traded Bitcoin. We made, I don't know, doubled 20% or so gain in a couple weeks on it. I'll trade, and I have no qualms. I'm equally comfortable and in just as frequent trading long and short. No bias to gold. I'm not a gold bug. When the trend is there and it's in a bull trend, there's going to be more long trades than shorts. But as you guys know, lately, wheat, corn, soybeans, certain sectors within the stock market. And so that's one thing. And I'm going to talk to you real quick about asset allocation. Not going to go very deep into this. I've done some more extensive videos in the past. But I want to talk about today, too. There was, in the trading room, saw some comments. People, some traders got charged up because we had this big drop. There was some news today, something about the trade wars, something to do with agriculture. Doesn't even matter to me. It's all noise. But that's the point I wanted to make. There was a sharp swoon down. If you're looking at the 1-minute charts, again, this is on a 1-minute chart, and it looked like a huge move, and it is relative to the volatility we've seen lately. But it wasn't that big. Now, here's where I'm going with this. Most important, it could have been technically significant, but it really wasn't. Sometimes you have a big spike up or down, and then it triggers a breakout of support. So my point is, I'm trying to impress the fact you need to learn to recognize which sharp moves in the market mean something and which ones are just noise, and then ignore that noise. Don't read too much into it. Don't let it reinforce your current bias, whether you're bullish or bearish, unless that move does something in the charts. In other words, had we smashed down through 8,200 on NQ, yeah, there you go. That's that would and printed a solid red candle down below it, especially followed up by another red candlestick. More downside selling. I would say absolutely technically significant. So there's a takeaway. Something I've learned over the years. Don't react emotionally. Some of these big spikes intraday can be the start of something much more, and you need to be aware of that. And that's why I go over these levels in advance. And whereas others are simply noise within the grind. Okay, and so quickly we're just going to do, turn to this chart here. This chart, and I would encourage you to do a Google search on the term. It's called the efficient frontier. So mix it in with the term asset allocation. Just real quick crash course for those of you not familiar. What is asset allocation? Well, you have different asset classes. The most common, the ones that everyone's familiar with, are stocks and bonds. Stocks and bonds, although they're always thrown around, are often in the same context. They're almost opposites in what they are. Stock is simply ownership in a company. It's a stake. If you bought every single share of the stock of a company, you own the entire company. You are the sole owner. But of course, most publicly traded companies have many, many shares, many, many owners. But that's equity. And then bonds are almost the opposite. It's an IOU. A company will sell a bond, or a government may sell a bond. It's an IOU. It's debt. They're promising to pay you back a certain rate of interest and your principal. So, and now the point is, stocks and bonds over time, don't worry about day to day, sometimes a period of months. You go back 20 years, 100 years, they tend to have an inverse correlation. One goes up and the other goes down. For many reasons, I won't get into the specifics now. There are a couple more than one reason: risk on, risk off, interest rates, future economic growth expectations, all that good stuff. But so these are your two primary asset classes. And you'll usually see this in these charts, but they're not. It's not all inclusive. Commodities are another asset class. Within commodities, you have hard commodities such as oil and things that come out of the ground, precious metals, industrial metals. Then you have your soft commodities, things that are grown, agricultural products, corn, wheat, soybeans, and these are the things that over the years we've had hundreds of trades on, literally, and I trade them frequently. So I'm actively trading commodities. Might be bullish on some at one time, bearish on others, long, short, and of course bonds. Many times trade treasury bonds, corporate bonds, high yield bonds, depending on the bond class. And so again, this is not all inclusive, but what this chart tells us, and what studies have been done that show and have proved, after pouring through hundreds and hundreds of performance of a lot of individual investors, professional asset managers, that they at your asset allocation mix to one's portfolio has a bigger impact on your returns than does individual security selection. So again, they looked at those that had proper asset allocation versus the best stock picker out there, and time over time, again, drawn out in these studies, this is the bigger determinant of having positive returns over the years. And what it basically tells you, you can see from this chart, here's a scale here. This is the risk down here. You move towards here, that's lower risk. You go down over here on the chart, you're moving towards higher risk, and then here's your returns. It's simple, right? You see them there, 10, 11, 12%. And so bonds, your steady Eddie bonds, guaranteed to pay your principal back at maturity, guaranteed to pay you a fixed coupon rate, have the lowest risk, but yet when you start introducing stocks in your portfolio, something happens. Not only do your returns go up, but your risk falls. And that is because, again, simply one will be going up, the other will be going down. It's a whole, don't put all your eggs in one basket and diversify. And of course, you mix in commodities, gold, other things. This gets even sweeter, in my opinion. But again, these are standard charts. And this is when most of the studies were done. They just use a simple stock bond allocation. It gets kind of too complex. You throw in too many things. And then you can see, so as you go out here, as you add in stocks, yes, you are increasing your returns. What this chart does not show you, and some do, you have to look at the standard deviation, the variation of returns. See what you'd have to realize. You might say, oh, okay, well, I'm taking more risk. What's the big deal? I want to juice my returns. First of all, the returns get incremental at this point. You start going out, your risk, this is a parabola, a parabolic curve right here. And so, I'm drawing a straight line. I can't, I don't have a parabola tool right now. So you're seeing a diminishing point of returns. But you're taking on a lot more risk. And I can tell you plain and simply, and if you've been around for a while, you know this. You can, if you put all your money in stocks, you think you're diversified in the S&P 500 index fund because you own 500 companies, right? That's very diversified, right? And not only that, you own 11 different sectors. Some of those sectors are defensive sectors like utilities and healthcare that should do well or at least hold up during a recession, right? But yet, in theory, yes, but in reality, no. During a bull market, all ships are lifted, they say, in a rising tide. The index will go up, and yeah, some sectors are doing better than others at other times. But especially during bear markets and correction, almost everything gets thrown out. And the baby gets thrown out with the bathwater, and most stocks fall. The last bear market we had, the S&P 500, with all its steady Eddie dividend payers and utilities, was still down about 55% in less than 2 years. And that's not the first time. It's not unusual to see, during a bear market, the entire stock market fall 30-50% or more. And so you don't have that in bonds. So that's why you have the risk increases exponentially when you start heading out here into all stocks. Now again, so where I'm going is mitigate your risk. And we'll wrap this video up. I'm going to make a point to how that works, because again, I've said this many times, and I just still continue to see too many comments out there, especially for those, if you're coming in, let's say, general market analysis is what I provide as public content on the YouTube channel and on the site. You can come in and read the charts that are just general market analysis. Whereas again, 99% or 90+% of what I trade personally, what the trade ideas that I make are everything but the stock market. They may be within there. I may sniff out a bullish sector that is poised to run, or a bearish sector, regardless of what the overall trend is. And at any given time, I'm usually throwing out trade ideas, be it long or short, on those things such as gold, silver, treasury bonds, corn, wheat, soybean, coffee, Bitcoin if the opportunity is there, marijuana stocks. And so here's what I was going to show you. I did the numbers here, and so let's just, given I'm cherry picking a point, but let's just say after all this noise, this washed a lot of investors out and traders, and this caught them off guard, and it was about this point, and the volume at price histogram tells me over here that's where most of the trades occurred. So let's just say, for the sake of this, you shorted, you're a bear, and you shorted the market, you think the market's going down, and you shorted here on May 1st. From that point through today, you are down about 4%. That's how much the S&P has climbed since that peak right there on May 1st. Now, so if you're a bear, you've lost, and you're only a bear on the S&P 500. That's all you trade. You're down for most of the year about 4%, right? Now, let's just go over a few other things, and these are things that we've had numerous trade ideas on. First one is gold. I've been, longer term bullish on gold for quite a while, and I still am. I'm viewing this quite like I'm a little cautious, near term cautious. I have, no positions other than active in and out. When I say that, I posted some charts today for you guys on the site. But for the most part, I'm waiting to see how this trading range resolves. I see the potential if we break some levels to go down to the next support, but that's not what I wanted to talk about. Let's just say on that same day, May 1st. Right after the end of April, you went long gold in part of a diversified portfolio. I was pounding the table on it here, back here, all along. And whether I did or not, I'm just making the example here. Well, gold, despite this recent correction, we've had a 3-month correction in gold, but still in a bull market. Gold is still up from that point about 15% through today, from May 1st. Okay, so let's look at another one. TLT, that's another one that we had official long trade ideas on treasury bonds back here. Had that actually when the market started to melt down. We were short stocks right off the highs, close to, not all the way down to lows, and we started to go long treasury bonds there. And throughout the first part of the year, I was clearly bullish on treasury bonds, and they were one of the best performing asset classes. So here's another example. If you were diversified, instead of just trying to figure out and make a big bet on where the stock market's going, you spread your bets. You didn't put all your eggs in one basket. And I'm doing this intentionally. I just picked several different asset classes here. So you have TLT, which is a completely separate asset class, from May 1st through today. Again, I've already measured it out. This might not be exact because I have to grab the candle. TLT is up 10%. And then finally, I'll just do one more because, again, it's a random, completely unrelated asset class, and that's Joe. We've had numerous trades on coffee this year. Almost all of those were long trades, and we timed and we got in here. We ran this first rally up. We got out. We had one or two that might have got in early, got stopped out, but then I added back levels, and the majority of trades have been long. And by far, they're almost all those double digits. Even this one most recently, I highlighted here as a breakout today. I did an update on that trade. And these trades, we're talking, 15, 20% on these. But let's just say, because I've been looking for a bottom in commodities, a lot of commodities in coffee. Let's just say again that you just decided to go long. And this is actually right about when we did that on this official trade. We milked almost this entire run and then got out on coffee. And that was 20-something percent. But again, the point is I'm picking that May 1st date. From May 1st to today, coffee is up about 13%. So I'm just going to recap it. A bear on the S&P, and what you see, for example, on the YouTube channel, when I'm saying, look, this market, there's no sell signals now. The long-term trend indicators are, to me, still clearly all the long-term indicators are bullish, but there are some red flags, and it's just not where I want to trade. No reason to fight it right now, but yet I don't want to be in that trade, as a position. So if you are been short, but if you wanted to hold on to a short, you're down about 4%. But on gold over that same period of time, you're up 15%. Treasury bonds, you're up 10%, and coffee, you're up 13%. And plain and simple, and that's again, I picked just a few things here, but that is how asset allocation works. So, to me, I first started working and learning about asset allocation many years ago, decades ago actually, as I was a financial advisor. It's paramount to an investor, any investor, but it is also just as important or critical, in my opinion, to an active trader, a swing trader. I wear many hats. I day trade, swing trade, and invest, and so by spreading out your bets, plain and simply, you're not gonna get them all right. Nobody bats 1,000, but you will over time enhance your returns. And again, active swing trading. I talked about Joe being up. What did I say? Coffee being up 13% since then. Again, these are the rips and dips we swing, and we didn't nail every bottom and every top, but we were pretty much long on each of these three major bottoms this year, and getting out, sidestepping the give backs for the most part, not perfectly, but for the most part on a lot of those. And that's just one of many examples. So we'll leave it there. So just food for thought. Again, whether you're an active trader or an investor, consider expand your horizon, and even if you're long and bullish the market and been long all year, kudos to you, congratulations. It's certainly moving up, but it's also the risk reward. It's the last, like I said, I pointed out here, since what was that, May 1st, we went up what was 4%. And that was again after. So we're in a trading range. It's upward, but it's a slightly upward trading range. It's almost I put the small caps are in a sideways trading range. This is the trading range the S&P is in. It is upwards. That is an upward trend. No arguing that. But as I showed you, we're watching those trend lines right here. Let's put them all back on. And today we broke the trend lines. We broke it in SPY. It's a green candle, basically a flat close. That's why you see a green candle, 0.03%. We broke it in QQQ. We don't see the impulsive selling that I want to see, but we closed below it. Not enough to really say, oh, wow, that's a great sell signal. In fact, we're closed right back on the line when I look at it on the daily chart here. And that's why I have those levels below on NQ and QQQ that I'm saying we need to see a little bit more work there. And you can see IWM broke below, but it's also back testing a trend line. So really, I'm not overly concerned with, unless you're trading IWM, but even if you are trading IWM, it's only going to go so far without. This, to me, it's almost the same chart as SPY, except it's a sideways trading range. There it is. Instead of a slightly higher trading range. There's been a bias towards the large cap stocks, but for the most part, they've all moved basically sideways almost the entire year, short of this V bottom, and that's why I'm frying other fish than the broad market. All right, we'll wrap it up here. This has been Randy Finney with the right side of the chart. Hope you enjoyed it.